Every time a missile lands near the Strait of Hormuz, somewhere in a London office, a number changes on a screen, and that number adds more to the price of your gas than the missile itself ever could. Not a government, not a general, not even the oil companies you assume are pulling the strings. A quiet room full of underwriters, recalculating risk in real time, deciding in that exact moment whether a tanker is allowed to sail at all. This is the part of the oil story almost nobody explains because it is not happening on a battlefield or a drilling platform. It is happening inside a spreadsheet, inside an insurance contract, inside a number most drivers filling up their tank will never once hear mentioned on the news. And once you understand how this number works, you will never watch a headline about the Strait of Hormuz the same way again. To understand why insurance, of all things, can move oil prices faster than an actual military strike, you first have to understand something almost nobody outside the shipping industry ever thinks about. A massive oil tanker, worth anywhere from $50 million to well over $100 million, carrying a cargo that can itself be worth tens of millions more, is not legally allowed to leave port without insurance covering it against catastrophic loss. This is not optional. It is not a business preference. Banks that finance these vessels require it. Ports that load and unload them require it. Charter contracts between oil companies and shipping operators require it. A tanker without valid insurance coverage is, for all practical purposes, a ship that cannot move because nobody along the entire supply chain, from the oil company to the port authority to the bank holding the loan on the vessel, will let it sail uninsured. Now, ordinary marine insurance covers the everyday risks of shipping, storms, mechanical failure, collisions, the normal hazards of moving heavy cargo across open water. But there is a separate, specific category of coverage called war risk insurance. And this is where the entire story of this video actually lives. War risk insurance exists specifically to cover vessels operating in or near conflict zones, areas where the normal risks of shipping are compounded by the possibility of missile strikes, mine warfare, seizure by hostile naval forces, or outright attack. And here is the critical detail that makes this whole system so powerful and so invisible at the same time. War risk insurance is not a fixed price. It is repriced constantly, sometimes multiple times within a single day, based on the underwriter's live assessment of how dangerous a specific route has become at that specific moment. Under normal, peaceful conditions, war risk premiums for a tanker transiting a stable waterway are almost trivially small, typically somewhere around 0.15% of the vessel's total insured value. On a tanker worth $100 million, that works out to roughly $150,000 per year of coverage, spread across dozens of voyages, making the cost per individual trip almost negligible, often just a few $1,000s tucked quietly into the overall cost of moving that cargo. Shippers barely think about it. It is background noise, a line item buried inside a much larger set of operating costs. But when tension spikes, when a missile actually lands near a shipping lane, when a government makes a threatening statement about closing a strait, when a tanker gets shadowed or harassed by a hostile naval vessel, underwriters do not wait for a formal ceasefire or a diplomatic resolution to reassess that number. They reassess it immediately, sometimes within hours of an incident, because their entire business model depends on accurately pricing risk before, not after, a disaster actually destroys a vessel they have agreed to cover. During periods of serious escalation, war risk premiums for transiting a genuinely contested route like the Strait of Hormuz have been known to spike from that baseline of roughly 0.15% all the way up toward 10% of a vessel's insured value. Run that math on the same $100 million tanker, and a single voyage that used to cost a few $1,000s in war risk coverage can suddenly cost somewhere between $150,000 and $225,000 or more, just for insurance, just for that one trip, before a single barrel of oil has even changed hands in a sale. This is the mechanism almost nobody talks about when a crisis flares up near a major oil choke point. The headlines focus on the missile, the warship, the diplomatic statement, because those are the dramatic, visible, easily filmed events. But the thing that actually determines whether oil keeps flowing through that choke point at a normal pace, or slows to a trickle, or stops moving through certain routes entirely, is a quiet recalculation happening inside insurance syndicates, largely concentrated in one specific place on the planet: the historic marine insurance market centered in London, built around an institution most people have heard of, only vaguely: Lloyd's of London. Lloyd's is not, strictly speaking, a single insurance company. It is better understood as a marketplace, a physical and financial meeting point where dozens of individual underwriting syndicates come together to collectively insure risks too large or too specialized for any single insurer to comfortably absorb alone. When a supertanker needs war risk coverage for a voyage through a contested strait, it is often not one company writing that policy, but a consortium of Lloyd's syndicates, each agreeing to cover a specific percentage of the total risk, pooling their capital and their appetite for danger into a single combined policy. This structure has existed in something close to its current form for centuries. Originally built around insuring merchant sailing ships against storms and piracy, and it has simply evolved layer by layer, generation by generation, into the institution that now quietly prices the risk of moving the modern world's oil supply through its most dangerous waterways. Alongside Lloyd's syndicates, another set of institutions plays an equally critical role in this system: protection and indemnity clubs, commonly known throughout the shipping industry simply as P&I clubs. These are mutual insurance associations owned collectively by ship owners themselves that cover a different but related category of risk, primarily liability, meaning the costs a ship owner might face if their vessel causes damage to a port, injures crew members, or triggers an environmental disaster like an oil spill. P&I clubs and war risk underwriters at Lloyd's operate somewhat separately, but during a genuine crisis, their assessments of risk tend to move in tandem, because both are ultimately looking at the same underlying question: how likely is it that this specific vessel on this specific route during this specific window of time gets damaged, seized, or destroyed? What makes this entire system so opaque to the outside world is that these premium calculations are not published on some public government website the way, say, interest rates set by a central bank are. They are negotiated privately, vessel by vessel, voyage by voyage, between ship owners, insurance brokers, and underwriting syndicates, often communicated through a tight, specialized network of maritime insurance brokers in London who spend their careers doing nothing else but pricing exactly this kind of risk. A journalist trying to report on rising oil prices during a Middle East crisis can call an oil company spokesperson, can quote a government official, can interview a geopolitical analyst. Getting a straight, timely answer out of a war risk underwriting syndicate about exactly how much premiums have moved in the last 48 hours is considerably harder, and that difficulty is precisely why this mechanism remains so poorly understood by the general public. Even though it is arguably doing more to move oil prices day to day during a crisis than the military actions themselves. To see exactly how this plays out in the real world, walk through how a crisis around the Strait of Hormuz actually moves through this insurance mechanism, escalation by escalation. In the earliest stage of rising tension before any actual attack has occurred, simply a war of words between governments, sharp statements, naval posturing, underwriters typically make modest preemptive adjustments to war risk premiums for vessels transiting the strait. This is a purely precautionary move, underwriters recognizing that the probability of an actual incident has ticked upward even slightly, and repricing accordingly to protect themselves against a rapidly changing risk environment. At this stage, the increase might be modest, premiums rising from that baseline 0.0001% to perhaps 0.5% or 1%, adding a noticeable but not yet dramatic cost to each transiting vessel. Then comes an actual incident, a drone strike near a tanker, a mine detonation, a vessel getting boarded or seized by naval forces, claiming to enforce some kind of blockade or inspection regime. This is the moment underwriters react most sharply because an actual attack transforms risk from theoretical to demonstrated. Insurers no longer have to imagine what might happen to a vessel transiting the strait. They have direct evidence of exactly what is happening to vessels transiting the strait right now, and they reprice accordingly. often within hours of confirmed reports reaching the market. This is the phase where premiums can spike toward that upper range, 5%, 7%, in the most extreme documented cases approaching or exceeding 10% of a vessel's insured value, transforming the cost of a single voyage by well over $100,000 in insurance alone. Ship owners and oil companies respond to this spike in one of a few predictable ways. Some simply pay the higher premium and continue shipping, passing that additional cost downstream into the price of the oil itself, because global demand for that oil has not disappeared just because the route has become more expensive to insure. Others, particularly operators with tighter margins or older, less valuable vessels that were already borderline uneconomical to insure at elevated risk levels, may choose to halt voyages through the strait entirely until premiums come back down, rerouting cargo through alternative, longer, and typically more expensive shipping routes where possible, or simply waiting out the crisis in port. Still others may find themselves unable to secure coverage at any price because, at the most extreme levels of risk, some underwriting syndicates may simply decline to offer war risk coverage for a specific route altogether, regardless of premium, effectively creating a situation where a vessel is legally barred from making that voyage, no matter how much the ship owner is willing to pay, because no insurer in the market is willing to accept that level of exposure at any price. This is the exact mechanism through which insurance pricing can functionally halt or dramatically slow the flow of oil through a critical choke point without a single blockade ever being physically imposed by a military force. Nobody has to sink a ship or lay a minefield to slow the flow of oil through the Strait of Hormuz. All that has to happen is for underwriters to collectively decide the risk has become too high to price reasonably. And ship owners, acting entirely rationally within their own economic interests, simply stop sending vessels through, or slow the pace dramatically while negotiating new coverage terms. The blockade, in this sense, is not physical, it is financial, and it is entirely legal, entirely voluntary, and entirely invisible to anyone not specifically watching the insurance market. Once tension begins to ease, whether through diplomatic negotiation, a temporary lull in hostilities, or simple exhaustion of whatever triggered the initial escalation, underwriters begin walking premiums back down, though typically not instantly and not always all the way back to baseline. Insurance markets, much like other financial markets, tend to price in a certain amount of residual caution even after an acute crisis appears to have passed, because underwriters know from painful historical experience that de-escalation can reverse just as quickly as escalation occurred. And they have little incentive to slash prices back to rock bottom levels the moment headlines calm down. This creates a lag effect where premiums and therefore the insurance cost embedded into every barrel of oil moving through the affected route remain somewhat elevated for weeks or even months after the most visible signs of crisis have faded from daily news coverage. Now trace this mechanism all the way from that London underwriting desk to the number displayed on a gas station sign, because this is where the abstract financial concept becomes something every single driver actually feels in their wallet. When war risk insurance premiums rise for tankers transiting a critical route like the Strait of Hormuz, shipping companies immediately pass that additional cost along to their customers, typically the oil companies chartering those vessels to move crude from Persian Gulf producers to refineries around the world. Those oil companies, in turn, factor the elevated shipping and insurance costs directly into the price they are willing to pay for crude at the point of origin, and into the price they charge once that crude has been refined into gasoline, diesel, and other petroleum products. Refineries pass their increased input costs along to wholesale distributors. Wholesale distributors pass those costs along to the gas stations that actually sell fuel to consumers. And gas stations, operating on notoriously thin profit margins themselves, pass virtually the entire increase straight through to the price displayed on the sign at the pump. This entire chain, from an underwriter's spreadsheet in London to the number on a gas station sign in an ordinary town, can complete itself remarkably quickly, often within days, sometimes faster, because global oil and fuel markets are extraordinarily well connected and extraordinarily fast moving. This is precisely why gas prices can visibly rise within days of a Middle East crisis flaring up, even when the actual physical flow of oil through the Strait of Hormuz has barely been disrupted at all. The disruption that matters in the earliest and often most economically significant phase of any crisis is not a disruption of physical oil supply. It is a disruption of insurance pricing, rippling downstream through shipping costs, wholesale costs, and retail prices, often well before any tanker has actually been forced to alter its route or halt its voyage. This distinction matters enormously for understanding what is actually happening whenever tension flares around a critical oil choke point. A missile strike near a tanker generates dramatic footage and urgent headlines, but the missile itself, in most cases, damages or destroys a single vessel, a genuinely serious event, but one that on its own represents only a tiny fraction of global oil shipping capacity. The insurance repricing that follows that missile strike, however, applies instantly and simultaneously to every single vessel currently transiting or planning to transit that same route, multiplying the economic impact of that one incident across an enormous number of ships and an enormous volume of oil, all through a single coordinated adjustment in how underwriters across Lloyd's syndicates and affiliated markets choose to price risk going forward. One missile, one vessel damaged, and potentially hundreds of tankers now facing dramatically higher insurance costs for every single voyage through that route until the market recalculates that risk back downward. This is why understanding modern oil prices purely through the traditional lens of supply and demand, how much oil is being pumped out of the ground versus how much the world wants to consume, misses a critical piece of how prices actually move in real time during a geopolitical crisis. Supply and demand absolutely still matter over longer time horizons, shaping the baseline price of crude oil based on how much is being produced globally versus how much refineries and consumers need. But during acute crises, particularly crises centered around narrow, strategically vital choke points like the Strait of Hormuz, the Suez Canal, or the Bab el-Mandeb Strait near Yemen, a second, faster-moving mechanism takes over almost entirely. A risk market phenomenon where the price of moving oil safely from point to point becomes just as significant and sometimes more immediately significant than the underlying price of the oil itself. This risk market dimension of oil pricing has become steadily more important over recent decades as global shipping lanes have grown more concentrated around a small number of critical, geographically narrow choke points, and as the instruments used to insure against risk along those routes have become more sophisticated, more responsive, and more tightly integrated into global financial markets. A relatively small specialized community of underwriters, brokers, and risk analysts concentrated heavily around London's historic insurance district now effectively holds significant influence over how quickly and how severely a regional conflict translates into a global economic shock, simply through their collective, largely private decisions about how to price the danger of moving cargo through contested waters. None of this means military action and geopolitics do not matter. They absolutely do, and in many cases, they are the underlying trigger that sets the entire insurance repricing mechanism into motion in the first place. But the next time a headline announces rising gas prices tied to a Middle East crisis, it is worth remembering that the missile or the warship making the news is often not, by itself, the thing draining extra dollars out of your wallet at the pump. Somewhere in a London office, a syndicate of underwriters looked at that same missile, recalculated a number most people will never see, and that recalculation, quiet, private, and largely invisible, may well be doing more to shape the price of your next tank of gas than the missile ever did. If this changed the way you think about what actually drives gas prices during a crisis, hit subscribe and let us know in the comments whether you had ever heard of war risk insurance before watching this, and share this with someone who still thinks it is just bombs and blockades setting the price at the pump.